have already joined the YouTube live stream, and I think that joining process will keep on going. So anyways, let me start this call with the introduction of the speaker of our event today, Radhika Gupta, CEO of Edelweiss Mutual Fund, CEO and MD of Edelweiss Mutual Fund. And she has been the CEO since 2017. And for me, if I have to put it in a very simple, one single phrase, she has broken the glass ceiling of our industry. Simply because of the fact that if you see the participants on this call, or the people who are watching, or the people who have invited, 99% of them are male audiences, because it is expected that a man will take care of the finances at home, or it is assumed that he's the one who will be better managing the money. But she has changed this whole perception towards how women at the pinnacle of Indian asset management industry. And just to give a little bit background about Radhika, I think she is an entrepreneur by heart, and that's what is visible in the way she conducts everything around. So she was one of the co-founders of Forefront Capital, which was acquired by Edelweiss in 2014, and she has actually moved across 4 different continents during her entire lifetime. So a lot of different experiences that she has had is helping her handle the current job profile that she's having. And she's honored with 30 most powerful women in Indian business. So that's an amazing feat that she has achieved. And when she joined Edelweiss, the assets under management of Edelweiss Mutual Fund was to the tune of maybe 6 to 7,000 crores, which has currently reached approximately 24,000 crores, and maybe more expected in the near future. And some of the funds like Edelweiss Balance Advantage Fund or Edelweiss Large Cap Fund have been category toppers in the last 3 years or so. I think I can speak more. She is a member of MFI board, her education, but I think I would not like to take too much time and space. So I would like Mr. Varun to take over this call now. And, so just some introduction about Mr. Varun. He was working with JP Morgan before joining Edelweiss Mutual Fund. I think as a part of the, acquisition of JP Morgan, he became a part of Edelweiss Mutual Fund, and currently heading the international funds bucket of Edelweiss Mutual Funds. So over to you both. Thanks very much.
Thank you, Kshitij, and good evening, and a very, very warm welcome to all of you. It's such a pleasure to have everyone on a call on a rainy day, and it couldn't have been more apt that we've been requested to speak about the US Technology Fund, which essentially is our main topic for today, on a tech platform, which is Zoom. In fact, just to give you a small background, I was listening to the earnings call of Satya Nadella, who's the CEO of Microsoft, and he started the call by saying, because of the COVID pandemic, 2 years worth of digital transformations has actually happened in 2 months. And, that's essentially where the world's moving to. The information of everyone, we did a launch of India's largest ETF today through the online platform, through YouTube. And we think, the world as we see it now, post-COVID, is going to be more digital, more online. And with that, I will request Radhika to speak about, this entire theme and how it stacks up as a great diversification tool for an investor in their portfolio, especially people sitting outside of US in markets like India. How can they take exposure to some great businesses internationally? Over to you, Radhika.
Just before you start, Radhika, I'm so sorry. Could you both just start your videos because we are just able to hear you. Your videos are, I think, off. That's my request.
I think the host has stopped the share.
Okay, I'll change that. No problem.
What I can do, Kshitij, is I can kick off, and because I have to share.
Fine. Yeah, I've done that. I think I've done that now. I think you'll be able to. Yeah. Thank you. Thanks.
So no, thank you, Varun, and thank you, Kshitij and team, for doing this. Thank you for the very warm introduction. Always feels good on a Friday. And thank you to the clients who've tuned in both via Zoom and via YouTube. It's, as Varun said, seminal that we do a presentation on US technology, and there's so much technology. In fact, I have to tell you, today has been a really chaotic day. This is probably my 9th digital event that I am doing today. And Varun was talking about the launch of our corporate bond ETF. It's a partnership with Government of India. And last year, when we did the first launch, I hail from Delhi, and of course, the corporate offices of government sit in Delhi. I actually took 100 flights to Delhi for that launch, and because there was so much coordination with public sector companies and government, this time I could not take a single flight. And even with people in the public sector, I mean, what you would call your old guard CPSC companies, everything, all our decision making happened in 1 hour on a WebEx that the Government of India hosted. So it's not just the private sector. Today, when we did our launch event, we had members of the press from 35 locations in India. We had people from the government, we had people from the stock exchange, and we had people from Edelweiss Group come together. And we had, of course, the public on a digital platform. So I think that tells you how digital the world and digital India is going. I have a board meeting next week, and about 3 of the board slides are devoted to the technology initiatives of AMC. So I think it's clearly, evident that COVID is the new chief technology officer around. What I'm going to do is I'm just going to share my screen so you can see my screen right away. If you have any problems while I speak, please put it in the chat window. And I thought that before that we get to US tech fund, it's important to put a context to this whole space of international investing and why you should think about it, because we really believe at Edelweiss that when you make investing decisions, you should make them for the right reasons. Now, one of the things that I have at least seen is that we've had international funds for 3-4 years in our basket, but the amount of excitement that I have seen about this category, the amount of questions, the amount of events that we do has never been as high as it probably has in the last few months. So before we jump into US tech, I wanted to talk about why you should think about investing in the international markets in the first place, because the most common instinct is I'm sitting in India, India is doing well. Now, it may not have done well for the last year, but why should I even think about this in the first place? And we think there are 3 reasons to look at offshore funds as a category. And I think these are the 3 important reasons to invest. One is, and this is very true of US tech, but also a lot of other companies, it is that you get access to ideas and companies that are not available in India. I think that is very, very important. There are lots of themes that are not even listed in our market. I mean, your largest stock exchange in India is not listed, for instance. Technology, of course, as a theme, if you look at many of the themes that we'll talk about in the presentation, things like 5G or cloud computing are not present in our Indian indices. But even beyond technology, one of the reasons to access international companies and international funds is to see themes that are not present in Indian markets today. The second benefit, and this is related, is the benefit of diversification. Not all markets do well at all points of time. And as I'll show you later, different markets perform differently at different points. It is very important when we build our portfolios as investors that we have a range of diversified asset classes. Diversification is not investing in 10 equity funds that are doing the same thing and investing in the same markets in the same way. It is investing in different instruments that behave differently from each other. I mean, I'll give you the simple example of diversification. I currently have 4 internet connections at home. 2 4G connections, 2 dongle connections, and 1 landline connection. I try to be diversified even there. So diversification is doing things that behave differently at different points in time. The third thing I think that's important for international funds is the element of currency depreciation. And we'll talk a little bit about that. As I said, in terms of access, I think some of the world's best businesses are businesses that we are all consumers of. If you look at your day-to-day life, I mean, if I look at the bed I'm sitting on and I hold the products around me, this guy and this guy, I mean, there are so many products that we consume as consumers that are made by some of the world's best businesses, but those businesses happen not to be listed in India. Now, an argument you could make is that I can buy some of those foreign companies directly. But the fact is, doing in LRS and identifying which companies to invest in yourselves is difficult. Then investing in them, paying withholding tax, doing all of this whole access problem is actually difficult. On a mutual fund platform, you can do this. You can buy a basket of these companies at relatively low cost, and we can talk about cost later in the presentation. And you can do it with as little as a small quantum of money. So I think the mutual fund makes the access very easy, and it's just like a domestic mutual fund investment. So I think the ease of convenience that international funds give you is very, very powerful. As far as diversification is concerned, just follow me through this chart. It's very interesting. And what it shows you is the performance of different countries at different points in time for the last 10 years. There are years when India has been the best performing market. Look at a year like 2009 or 2012. But there are also years where India has not been a great performing market. Look at 2019 and look at 2011. Incidentally, if I showed you this data for 2020, you can guess maybe another market would have been the best performing one. If you also look at the right, what you'll see is that in terms of annualized returns, the US has actually been the best performing market over the last 10 years. And if you look at the next column, which is annualized risk, the US has also been the lowest volatility market. Now, this is not an anti-India pitch. It is only to tell you that different markets do well at different points in time. And as investors, it makes sense to just have a collection of different markets, or at least the big global markets in your portfolio. In fact, I was surprised when I saw this data, but since 1990, the correlation between the India and US market has only been 0.07. So they're actually two very different asset classes. And later in this, I'll show you an example of what investing a US fund can do to your portfolio, both in terms of risk and return. But remember, diversification is very important. The third thing that I alluded to was the importance of currency. This is the performance of the Indian rupee since 1980, and the currency has and I think will continue to depreciate at some rate. Historically, that rate has been 4%. When you invest in international funds, especially US funds, it's a direct hedge on the currency. If you have international expenses that you may have at any point in time, then this is also a way to hedge that out. In fact, what happens, and follow this again with me. This is a chart that shows you the return of the S&P 500. And the next column shows you the appreciation of the USD versus the INR. What is interesting is that in years like 2011 and 13, when India market badly, the US does well, which is the first line, but also the currency does well against the rupee. So if you're an Indian investor, you feel a double whammy. My equity market has done badly and my currency has done badly. If you're investing in a US fund, you have the benefit of the equity and the currency. And here we've given you an example of a blended 60-40 portfolio and what that can do. So the currency lifts the return as well as the diversification lifting the return. And that's just something to keep in mind. So I think those are the three reasons to invest in international funds. The reason is not that India is going to do badly. Different markets do well at different points in time. The reason I also don't think is that US funds have done well in the last year. That's great, and hopefully they'll continue to do well, but invest for these three reasons. I think these are very strong foundational reasons. Incidentally, I have been investing in international funds as a category personally since 2011. And when people talk to me about this category, I say invest constantly. Make this a core part of your allocation. Don't try to time it and say, I'm going to do US now and then not do it later. You're ultimately investing in equity. Invest with the same mindset that you invest in Indian equity, but in a different market. As far as international markets, at Edelweiss, we inherited this business when we acquired the JP Morgan mutual fund business somewhere in 2016-17. And now we have 6 fund offerings in partnership with JP Morgan, which is what you see on your screen today. We are very excited about partnering in this business with JP Morgan. We do believe they're a large global asset manager that has significant expertise and a large team and country specialists managing each of these funds. And all of our schemes are essentially fund of funds investing in the underlying JP Morgan scheme. So we are really bringing you one of the best asset managers in the world to give you access to some of these ideas. For the purposes of today's conversation, what we're going to do is focus on the US Technology Fund for our conversation. But if you have any questions on any of the other ideas that you see here, Varun and I would be more than happy to answer them in the Q&A session. As far as the US Technology Fund, let me just talk a little bit about the idea. This was a fund that was launched by Edelweiss in Feb 2020 of this year, but it is a very old offering that JP Morgan has. So it's a flagship fund for JP Morgan. We brought it to India this year. And essentially, it's looking for companies that have a few attributes. Technology-driven companies with a disruptive business model. So you're not looking at mature market companies. You're looking at companies that have a disruptive business model. While having a disruptive business model, it's also very important that these companies are not addressing a niche market. They're addressing a large market. Also, their competitive advantage is something that has to be sustainable. It can't be a fly-by-night kind of thing. And then finally, I think in any team, in any business, whether US, India, technology, otherwise, a management team quality is important. So a business with a good quality management team. So these are the companies that we're trying to look at. And the fund is investing in these underlying companies focused on the US markets. Why the US markets? And, I've lived in the US for a significant part of my career. The US is really the hotbed of innovation. It's the hotbed of creation of ideas and technology, and it's the hotbed of funding and regulatory environment for this, for this space. So, when you think technology, you really think US as a home ground, and hence the US Technology Fund. There are a few specific themes, and I think these are all themes that we'll relate to. We sometimes tend to think technology is a sector fund. I don't think this is a sector fund. I think technology and disruptive technology is a theme that spans any sector, whether it is auto, whether it is BFSI, whether it is entertainment. Technology is relevant to me. It's relevant to a CEO of an auto company. It's relevant to the CEO of an entertainment company. So technology is a theme that is relevant. These are 6 themes that we are looking at. All of these will be familiar. Cloud computing. Most companies are moving to cloud. Edelweiss AMC itself moved to cloud about 2 years ago. So everyone is using cloud to streamline their workflow and for security reasons. Artificial intelligence, a big paradigm shift is underway. The need for data, the need for smart analytics. In my own business, I'm starting to talk to AI companies to see how we can do finer customer analytics. So customer analytics, data is the new oil. Everyone's looking at artificial intelligence. Autonomous cars, I think enough is said and heard about Tesla and the Tesla story. But computing power is obviously further enhancing cars, so autonomous cars. Anyone who's been sitting in India in the lockdown knows that our friends at Paytm and PhonePe and other such electronic payment companies have enabled what we are doing. In India, companies like Paytm and PhonePe are not listed, but their equivalents are listed globally. So electronic is a big space. Over-the-top streaming, we know what's kept us busy during this lockdown and kept us entertained. In fact, Varun and I had a conversation with CEO of Z5 as one of our own training things. And really, he comes from a traditional ZTV background. OTT is kind of the space that is erupting. I mean, it was one of the few companies I was talking to, even in the Indian context, that was having a great time from a business point of view during the lockdown. And then, of course, 5G and the need for higher connectivity. So these are the mega trends enabling technology. One thing that you will notice is that if you look at India and what we think of in terms of conventional IT, these are not the themes. When we think of IT in our Indian indices, we think of Infosys and Wipro and companies like that. This is a very different world of technology from our traditional Indian IT things. And technology is a wide space. You have complete early stage ideas to complete late stage ideas. Where US tech is focusing on is the middle end of the curve. So you're not looking at many of these hardware stories that are very mature, your smartphone, tablet, where penetration is high. And you're also not focusing on the other end of the curve where the spike hasn't happened. So you're not doing Bitcoin either. You're doing these themes that are somewhere in the middle where the market is large and the takeoff has started. I think we'll cover specific stocks if there are questions a little later, but a couple of interesting points to cover here. The fund is a multi-cap fund in its nature. You can see the different market capitalization that the fund has looked at. So the fund has been really dynamic in terms of the market cap and investing across the market cap spectrum compared to some of the other technology themes like Nasdaq, which is very much large cap. This is multi-cap in nature. As I said, this fund for the JP Morgan team is a very old fund. In fact, its track record stems from 1997. It's also a $1.5 billion fund. $1,500 million fund globally. The other thing to keep in mind is that it is a significantly diversified fund. So it's not a fund where 50% of positions are in 5 different companies. If you look at the top 5 stocks, you'll see that there's 3 to 4% weight in even some of the top holdings. By the way, Microsoft is an interesting one. I always think that's exciting. I mean, I have lived this whole lockdown on Microsoft Teams. But the fact that it's diversified, which is very important in technology, because in technology, ideas fail as well. So this is a diversified fund in construct. Performance is obviously important to look at. This is just a lens as how performance has played out, both calendar year and annualized performance over a short and long-term time horizon. I would always caution customers the returns look outstanding on this fund. So it's not a fund to invest in just because of returns. I think there's a lot more. If you're looking at this fund, look at the theme, look at the diversification benefits. But needless to say, technology is a theme that has done well over the last 10 years. I mean, it's been a decade of technology, and it's hard to see why that won't happen going forward. I think this is, if there's one slide to keep in mind, I would definitely look at this slide. And to me, this is the case to look at a fund like this. What we have done here is we've shown you at the very top a portfolio that is 100% Nifty. That's a proxy for the Indian market and the 10-year returns and the 10-year risk. At the bottom, we've shown you a 100% US tech fund. Now, 2 things to keep in mind. Of course, US tech has done better than Nifty, fine. US tech is also more risky than Nifty. So just by investing in international equities doesn't mean they're less risky. This is technology. This is a theme. It does have risk. However, what's interesting is look at the portfolios in the middle. So look at the portfolio, that's the third line, 20% US tech, 80% Nifty. Your 10-year return goes up by a couple of percent. But note there is also a dramatic drop in your risk. That is the case to look at an opportunity like this. It brings genuine diversification to your portfolio because it's less correlated. So the reason to look at something like 10-20% is when you add it to a basket of Nifty companies, it gives your portfolio a very different flavor. And of course, it will be less correlated because all those themes that I talked about in terms of autonomous cars or 5G or payments are not represented in your Nifty or Indian indices. A common question that comes up, so I thought I would cover it here, is also how does this stack up to some of the other themes that are there around technology? Nasdaq is a common one that people ask us questions about. This is a pure play tech fund. If you look at something like Nasdaq, it is 55% technology. There's a substantial amount of consumer and healthcare and some of these other sectors. Nasdaq tends to be a large cap fund. This is multi-cap in nature. I think most importantly, Nasdaq is very concentrated in 5 names. So if you look at the bottom right, 5 names tend to make up about 40% of the Nasdaq. This is very well diversified in terms of names. So I think that's another difference, in terms of US tech versus Nasdaq. And we've already talked about the outlook for some of these companies. In fact, I think recently, and we can send this data, Financial Times published the companies, the 100 companies that have done really well during the pandemic. And many of the names that are top holdings of the US tech fund not surprisingly, were part of that list. I think technology, as we talked about, is a theme that in any case has been interesting, but COVID has only accelerated the need for technology. So I think that's something to keep in mind. And we continue to do work and look at companies where there is strong consumer demand, where there is a secular growth story. And I think we are very excited about this theme going forward. With that, Varun, if I can turn it over to you and you can share any further specific insights on this, and then maybe we can take questions.
Sure. Thanks, Radhika. I think Radhika has covered a lot of ground and put a lot of food for thought for investors to look at the US Technology Fund. But I wanted to take a few specific examples to give you a sense where this fund is going. So let me talk about a company that we hold in our portfolio, which is very disruptive in nature, and that is the genesis of picking up a business in the US Technology Fund. So there is a stock called Dexcom, which is listed in the US. Now, Dexcom is not a technology company, it's a healthcare company. What Dexcom does is it makes glucose monitors, which patients who are diabetic can attach it to their skin. Now, what happens is for diabetic patients, they need to constantly monitor their glucose levels, and they need to take blood samples at least 3 times a day. But in Dexcom's case, it monitors a patient's glucose level on a constant basis. And as there is a spike or there is a drop in glucose level, it sends a message not only on the customer's smartphone, it also sends the message to the doctor that, this is the trend of glucose levels, and medication, food habits, exercise, etc. can be adjusted accordingly. And what data suggests is that survival rate for people who are suffering from diabetes, it goes up by about 70% by using something like this. And we think this is in that early stage of takeoff where it can very well become the next Google or an Apple, because we know the number of diabetics that exist globally, and that number is just going up. So those are the kind of businesses that the fund is looking to invest in. I will take another example and then take a pause. The fund also invests in something called semiconductors. Now, semiconductors are essentially devices which are put in all electronic items. They follow a different process code for a different reason. In, say, an Apple phone, there are multiple semiconductors, from usage of batteries to multiple app functions, etc. But where the world is going forward is going to something called as Internet of Things. Now, Internet of Things is things are becoming smarter by the day. Now, take an example of a farmer who used to plow his fields, water his fields, and generate a crop yield. The way the world is moving forward, because of use of technology, Internet of Things is coming into being. So what is happening is, in the US, farmers are putting sensors in the soil. These sensors monitor the amount of moisture or water required for a better crop yield. Now, that sends data when the soil requires more moisture. And there are sprinklers which come on whenever the moisture content goes below its normal yield. And what also happens is it is tied to the internet. So there is a constant monitor of the weather forecast. So if there is rain in the horizon, there is no watering of the plants, because the natural water is anyways going to get to the plants. And that, in fact, has increased crop yield by about 40-50% on these crop fields. And this is just one case that I am telling you. There are cases where these semiconductors are put in our refrigerators, our homes, our cars, and they're just making things more efficient and saving time and money for people. So that is where the world is progressing, and those are integral parts of the holdings of this fund. And I thought it's important to make that point, or put that point across, for people to understand that it does not only buy into the Googles and Apples of the world, it also buys into some really new age crack technology businesses, or businesses which use technology at the back end. So with that, I think let's take a pause and see what questions come our way.
Yeah, sure. So some of the questions which we already had, during our previous discussion with some of our investors, one of the biggest worry is for the fact that, when this fund was launched, the fund of Edelweiss, in March 2020, and since then, investors have had CAGR returns of 82.5%, and absolute returns of maybe 27%, and which is obviously visible from the fact that Nasdaq is at an all-time high. So maybe some of the companies which are a part of Nasdaq is also part of this technology fund. So there are some investor concerns with respect to if have we reached a point where there are corrections expected in the near future, or should we be worried about the outperformance of this fund at this point of time?
Let me start with this. Our first point, or the point that Radhika covered earlier, was that this is a fund that makes part of the portfolio, and it is an ongoing investment process. We clearly think that we don't have a crystal ball to gaze and tell you if we've reached the top of the valuation cycle, or the valuation, because earnings are going to follow post the pandemic, whether valuations will get adjusted to their normal levels. But what our advice to a lot of investors is that please evaluate this fund from a very systematic kind of an investment route. Please put money regularly in the fund, and then you are averaging through the course of the fund. Because what investors also need to understand is they are investing for the future. And some of these businesses might look that they are expensive right now, but if you have a 5-7 year investment horizon, you probably will average out during the course. Radhika, would you like to add stuff to this?
Yeah, I would actually like to reiterate a few points. One is that, of course, everyone is aware and has asked questions about the Nasdaq rally, and you can't extrapolate into the future. That said, when we see the commentary from JP Morgan, they are making appropriate changes in the portfolio to reflect some of this. Technology companies always trade at not average valuations. I would definitely say that. And if you look at the last 2 decades, technology has been a significant part of the contributor to earnings. That said, I would also repeat that the fund is volatile. It is an equity fund in nature. It's hard to crystal gaze. So I think, it's one a part of your portfolio. So, it's not, hopefully, US tech should never be 100% of someone's portfolio. The staggered approach is terrific, actually. I love doing SIPs in international funds. We do them in domestic funds. It is good to do them in international funds. And thirdly, I think Indian investors are very under-allocated to international markets as a space. So also think about that.
Second question that we had was one of our young investors, who had just started investing maybe in the last 2 or 3 years. He was thinking of having international funds in general, to the tune of maybe 70% of his entire portfolio, maybe 70-80%, considering the fact that his risk profile is that he's investing these funds for long term. So would we recommend a 70 to 80% of our allocation in international equities, or maybe this particular fund?
Okay, so I'll give my take and then Varun can answer. Firstly, I think Kshitij, you and team are, as advisors, probably the best placed to answer that question. And I would definitely tell the young investor to use your advice wisely on this. I would say that, you are young, and asset allocation is a very, I don't mean to avoid the question, asset allocation is a very personal decision. Not every young person takes a large amount of risks. I was a very conservative young person, and some people are very aggressive. So I think that's a call. In general, when you see domestic investors, they don't have 70 to 80% allocation to international funds. That doesn't mean you can't. Think about your total equity allocation, right? If you're 70% to international funds, I'm assuming you're 100% to India equity. Or 100% to equity, which is quite aggressive in nature. So on the outset, it looks aggressive. I would just caution you one thing. Ask yourself why you're doing this allocation. Are you doing it because international markets have done well in the last 2-3 years and India has not? that is a bad reason to do it. So I would ask yourselves these questions honestly. Varun, if you want to add anything.
In fact, Radhika, just taking on from what you said, ask yourself, what does an international fund bring to the table for you as an investor? And look at it from a very common sense standpoint. Uh, Look at India and China, the two geographies where demographics or large population or large middle class is favoring the growth of India and China to be, number one and number two in 10 years from now. So China being the largest economy by GDP, followed by India, and US falling to number three. The reason why all of this is happening is because of the large consumer base that represents India and China, the large middle class. So, good to have a lot of Indian funds and also some Chinese funds, because the kind of consumption businesses that you will get in India and China, you probably will not get them in the US. The kind of banks that you will get in India and China, because all of this consumption is going to be boosted or kind of spurred by banks, you will not get those banks in the US. But when it comes to technology, those kind of businesses are not available in our local market, and for that reason you will have to go to US till the time we don't have a Google or an Apple replacement coming into India. If a Geo becomes one, you should look at investing a sizable amount into Geo, and which your Indian domestic fund managers automatically will do for you. I think look at it from that standpoint.
Yeah, actually, I'll just share the thought process behind this, 70% allocation that I had a discussion with the individual. His thought process, being a millennial, is the fact that there are no boundaries or borders. As you can see, we are using an American technology software or an application which is built by a Chinese individual. So, the thought process behind this is that maybe some of the biggest companies in India or the world, maybe the Amazons and the Teslas or the Googles of the world, because, as you both rightly mentioned that, we are using OTT platform like Netflix on a daily basis. We have Apple and Google devices on our hands, and we are ordering from Amazon. So, that is the thought process with which he came to me. And that's why I just had this question. So we have one participant who has asked a question to the panelists. I'll just take it. I've been investing since 5 years. With this pandemic. From 25% aggregate growth, I've come down to 0% growth. Should I look for international funds for investments now? And second, the follow-up question is, during this situation, should I keep doing monthly investments or put something in lump sum?
Well, I'll share my take on it. I think the first question we have covered a little bit. I think it's probably sounding a little repetitive, but I think it is important to repeat that, global growth world over has slowed down because of the pandemic. Obviously, technology is a diversifier to that growth because it's benefiting from the lack of physical availability and physical industries. So growth will slow down across the board. I mean, even if you look at the S&P rally, it is largely driven by a small set of companies, which happens to be tech companies. So remember that growth and equity markets are going to slow down across the board. That's a fact of the matter. International funds will bring, and something like this will definitely bring some cushioning and diversification to your portfolio. Whether you should do lump sum or STP, I think it's a good question. I think it's worth having an SIP in a fund like this. It kills some of the volatility and it builds an ongoing allocation. I would start with having some base allocation to international funds and growing it just like you grow your Indian wealth through SIP. You have a lump sum allocation and then you grow your base wealth. I would adopt the same approach to international funds. In fact, I think the meta takeaway is that you have to look at Indian equity and international equity. They're both equity at the end of the day. Look at the approach. The good investment practices are similar for both of them.
Right. Next question is with respect to the portfolio. I think you guys have covered a large part of it during your presentation itself. But the point that the investor is trying to make here is that how does the identification of companies happen? The reason behind this question is the fact that a lot of times many of the technology companies are not getting listed, and with an obvious reason of maybe profitability as a part of the as a question mark. But the point that the investor was trying to make as a part of this question is that how does the filtering process happen? If in brief, if you could explain.
Why don't you want to take that?
Yeah, Radhika, you covered that in the presentation as well, but I'll just take that with an example. So what Radhika told everyone was that we look at 4 basic parameters before we invest in a company. So it essentially has to have a large addressable market. It has to have a disruptive business model, a sustained competitive advantage, and a great management to really back all of that and take or propel the business forward. Now, this question also tells us that a lot of these companies aren't profitable at this point in time. So let me take the example of Tesla, since Tesla is not profitable as yet. This investment team, the portfolio management team, does not manage any other fund. They manage only this one particular scheme. So they look at all companies that are in the portfolio, that are in the universe, and a lot of businesses that are not even listed. Because the next disruption to their portfolio is going to come from an unlisted company, which is right now being funded by a PE or an angel investor, and in due course of time is going to get listed. But having said that, look at Tesla. Tesla was not part of the portfolio, and Tesla's been in the markets for a fair bit of time. And Tesla wasn't part of the portfolio because it was not generating appropriate revenues. It wasn't coming out to be profitable in the near future. And all estimates on the street were that Tesla is going to get profitable by 2025. But everything changed in the month of December. In the month of December, Panasonic, which supplies batteries to Tesla, they were supposed to give out about 100,000 batteries, and finally they gave out a number which was 2.5x of that. About 2.5 lakh batteries were sent to Tesla. And when the street saw this number and computed this number, it came about that Tesla, instead of turning profitable by 2025, should turn profitable by 2022. And that the point that I'm trying to make, I'm not trying to confuse you guys with all these numbers. The point that I'm trying to make is the fund is so actively managed. There are people who are always on the money, always on the lookout for ideas that are not part of the portfolio but can be part of the portfolio. And even these businesses which are not making loss, which are not making profit right now, but in the near future, once they start making profit, their stock price is going to go up. And going back to that Tesla stock price example, at that point in time when the fund bought into Tesla, the stock was at about $400. Presently, the stock's trading at about $1,200. So that is what active management by this team brings to the table.
Perfect. I think that answers the question to the perfectly. One question that which is a little bit divergent from the topic, but then since it has been asked to me, I would like to put it forward to both of you. Maybe Radhika would be in the right this thing to answer the question, is with respect to the fundamentals of Indian equity markets post pandemic. Do you see any changes in the long run? For an investor who is investing in equities. The reason for this question is that, as you had seen, the question which was asked to panelists was the fact that since 5 years, the returns of the individual's mutual fund portfolio has become almost 0%. So does the fundamental change because of the situation that we are in currently?
I will answer this question in two parts, and I also appreciate where the concern is coming from. I don't think the long-term fundamentals of India as an economy change, but I do think that you could be posed for, to be honest, 6 to 12 or 18 difficult months. Now, markets move ahead of economy. So I'm not talking markets, I'm talking about economy. But I would also say that if you look at the Indian economy, and if you look at any period in the Indian economy, it goes through periods of 12 to 18 months of challenges. This is a part of economic cycles. I mean, economic cycles are typically 7 to 8 years long. And if you look at any 5-7 year period in India, I mean, I like to quote the example of the decade of the early 90s. It was a decade with a tremendous amount of chaos. But ultimately, growth found its way. And I think while what you hear a lot about is the negativity of corporate earnings, all of that, the credit stresses, etc., etc., There are also equal green shoots coming in the way because of action by regulators, because of action by central banks. So these are counterbalancing forces. I also want to make a point to investors on the worry that you mentioned, because that is a real worry. And I know that when you look at your portfolios today, and the media also says this, you feel like, yeah, why should I invest in equity? Mera to FD would have done better. I mean, this is the natural side. Um, I would caution you against evaluating your equity portfolios after a significant market correction or after a significant market rally. When you evaluate your portfolio like this, it will be very difficult to invest in equities. You're looking at equities after one of their worst periods. It's like me doing your appraisal after the worst month in your career and just saying, yeah, वो आपका 1 month के basis पे मैं appraisal कर देती हूँ, बाकी 11 महीने छोड़ दो. Listen, you have to look at a rolling 3-year or 5-year kind of outcome for equities. Otherwise, you'll never have the confidence to invest in equities again if you look at it only after a correction. In fact, one of the statistics that we looked at was in the context of SIP returns. If you look at 10-year SIP returns, and even if you look at a case where markets have given nothing, 0 to 8% on average, your 10-year SIP return is still about 9% when your market return is 6-7%. So I think investing over the long term, that story doesn't change. But do realize that long term is a combination of painful short terms and then very extreme positives also.
Absolutely. I think we have, this is the last question that we are going to take for the day. We have Mr. Vinay Kamath, who is one of the panelists. He has a question to ask to both of you. Just asking.
Yeah. Yeah. Hi. You already have touched on this, but then I just wanted to ask, do you foresee any currency risk in this? Because we are investing in international fund. I know that in long term it may get stabilized, but do you foresee a risk in short term? Especially looking at the current scenario.
So one, I am not a great forecaster of currency. I think that's hard to say. In fact, in the last month, I think the rupee has appreciated 2.5%. So that's something that you have to keep in mind. Currency moves both ways. Currency is, at least in my experience, also correlated to equity market performance. So the years when there is a terrible Indian equity market, there is generally a risk of dollar becomes the preferred currency, dollar appreciates against the rupee, and vice versa happens in good markets. I think, again, if you're looking at this fund, you won't be looking at the less than 3 to 5 year horizon. So in the long term, I think it's good to look at the historical case and see that the INR at least has depreciated about 2 to 3% a year. But month on month, there can be volatility in the currency. And I'm giving you an example of last month. The currency appreciated 2.5%. Varun, if you want to add to that.
I think, Radhika, you've hit the nail on the head. In fact, we did a call with our institutional equities head, Shiv Sehgal, since he tracks currency very, very closely, and this call wasn't very far back. He made this point that a lot of FII flows are coming back into India, given that there's strong liquidity abroad, and that are having an effect on the Indian rupee, and the rupee is gaining strength. But like Radhika mentioned, that is a very, our currency, shouldn't be looked at, especially for this fund, on a shorter term horizon. If our investment horizon is 3 to 5 years, in 3 to 5 years, what we've seen is the normal course will prevail, and the dollar will gain relative strength.
Okay.
Thank you. Yeah.
So I think we have almost reached our time limit that we had requested for. So I would request Mr. Bharat Dhruv to give a vote of thanks to Mr. Varun and Ms. Radhika before we end this call. Yeah. I think there's some issue with Mr. Bharat Dhruv's connection. Can you take it over?
Yeah. Yeah, on behalf of Orbit Financial Services, I give a hearty vote of thanks to Radhika and Varun for sparing your valuable time and energy over here, and given a very deep knowledge about US tech fund. Because one understanding we had is it's a technology fund, but you clearly make out that it's not been a technology fund, it's a well diversified equity fund. So thank you very much for being a part of our journey over here. And I once again thanks.
And we'd like to thank each and every participant and the YouTube viewers at this point of time. Thanks a lot for joining in.
Thank you, everyone. Thank you, Radhika.
Yeah. Thanks, Radhika. Thanks, Varun. Take care.